Ever wondered how to determine if a stock is under, over, or fairly valued? The answer might lie in a little-known metric called the PEG ratio. Today, we're going to unpack this financial concept and explain how it can be a powerful tool for investors. At its heart, the PEG ratio is built on the foundation of the pay ratio, also known as the price-to-earnings ratio. This ratio gives an insight into how much investors are willing to shell out for each dollar of a company's earnings. It's pretty straightforward to calculate. The market price per share gets divided by the earnings per share. But there's more to the story. What if a company is on an upward trajectory? That's when the growth factor enters the equation. The growth factor is a measure of a company's potential represented by the projected historical percentage growth in earnings over a certain period. Now merge the pay ratio and the growth factor and we get the PEG ratio. This can be calculated by dividing the pay ratio by the earnings growth rate. What makes the PEG ratio so potent is that it provides a more comprehensive view of a stock's valuation, taking into account both its current price and its growth potential. So how do you interpret PEG ratios? A PEG ratio less than 1 might hint at potential undervaluation. This suggests that the market might be overlooking the company's growth prospects. On the other hand, a PEG ratio equal to 1 indicates fair valuation. If the PEG ratio is greater than 1, it could mean that investors are paying a premium for the stock relative to its growth rate. But remember, the PEG ratio, like any tool, has its limitations. It presumes a linear relationship between earnings growth and valuation, and its accuracy hinges on the reliability of earnings growth estimates. It's crucial to use the PEG ratio in tandem with other metrics and take the broader economic context into account. So there you have it, the PEG ratio in a nutshell. If you're looking to dive deeper into financial concepts or have any questions, don't hesitate to drop a comment below. And if you found this video helpful, make sure to hit the like button and subscribe for more insightful content. Until next time, happy investing.